You want to pass your SAFE exam? Let's make sure you understand TILA. Here's our overview for today. This is from the official SAFE exam test outline. We're going to go through the purpose of TILA, what loans are covered. We're going to go through some of the definitions that are on the test outline. We'll talk about the notice of right to rescind, go over HOPA, high cost mortgages. We'll talk about high price mortgage loans, finish with the MLO comp rule. And then we're going to talk a little bit about what you absolutely need to know, right? We're going to spend a bunch of time going through the details, but what do you need to know at a 10,000 foot view? And what should you maybe not waste your time studying? Let's get started. All right, TILA is known as Regulation Z. It's the Truth in Lending Act, and you can know it. A good memory trick to know it is that TILA be Godzilla. It's enforced by the CFPB as well as individual state regulators. And let's talk about the big picture of TILA, and then we'll go into some more depth here. TILA is going to set up some rules around advertising, some rules around finance charges and APR. It's going to tell us if a loan is considered high cost, and if it is high cost, maybe there's some things that are prohibited, and maybe there's some things that we have to do. It's going to tell us if a loan is higher priced and what that means. Sets up a right of rescission, and it also sets up some rules around loan originator compensation. Now, what loans are covered under TILA? That's going to be most forms of consumer credit, but TILA is not going to apply to business or to commercial loans. Now, in terms of the definitions that you need to know for TILA, the outline only has 4 terms, but it's important to understand these 2 terms as well. The first is going to be the finance charge. The finance charge is the cost of credit expressed as a dollar amount. So you can take all of the charges that are finance charges, add them together, and that gives you the finance charge. We'll talk a little bit more about different fees and whether they're considered finance charges, but understand that the finance charge, according to the law and as defined in the law, is that it is the cost of credit expressed as a dollar amount. Now you also have the APR. That's known as the annual percentage rate, but that's going to be the cost of credit expressed as a percentage. So you may, when you hear percentage and you think about loans, you're probably thinking about the interest rate. And the APR is like the interest rate, except it includes all the finance charges on the loan. For instance, the interest rate is just the rate of interest, but the finance charge would include the APR would include other finance charges such as origination fees, mortgage insurance, etc. We'll get into more detail there. It's also important to understand, what is a dwelling? A dwelling is going to be a residential structure of 1 to 4 units, but it doesn't necessarily need to be real property. What is the distinction there? Why do we care if it's real property? Well, if it's a manufactured home, it may not be considered real property. However, under TILA, it is considered a dwelling. So for the purposes of TILA, a residential mortgage loan is a consumer credit transaction that is secured by a dwelling. That means that if you have a manufactured home, it is covered under TILA. It is a residential mortgage loan. It's important to know 2 other definitions, and they're pretty easy, straightforward definitions. So I'm putting them here because it's kind of how the law is divided into open-end and closed-end credit. Open-end credit is credit that is revolving and can be drawn repeatedly. So think about credit cards, think about home equity lines of credit. These are things that you can charge, pay down, and then charge again. Whereas you also have what's called closed-end credit. Closed-end credit is credit where the funds are drawn once and once only. So think of that as like a personal loan or a mortgage. Okay, TILA sets up what's called triggering terms. And triggering terms are terms that if you use them, or terms of loan that if you disclose them, you must disclose the APR. So there's a number of examples of triggering terms, but these are the common ones that you'll see, and these are the ones that are cited in the law. The first one's going to be the amount of a down payment. So if you say $5,000 down, that's a trigger term. If you give the amount of any payment, so it's a $500 a month monthly payment, that's a trigger term. If you were to quote an interest rate, that's a trigger term. Or if you were to quote a number of payments, that's a trigger term. Similarly, any amount of any finance charge, such as a origination fee, a mortgage insurance fee, something like that, that is going to be a trigger term. Here's how I like to think about trigger terms, though. I always say it's any number related to the loan that isn't the APR will be a trigger term. So any sort of number that relates to the loan will be a trigger term, especially for test purposes. You'll see questions like a low down payment. Is that a trigger term? Well, no, you didn't actually disclose any down payment amount. Now, here's a common gotcha. If you see no money down, is that a trigger term? And you have to think about it. So think about it for a second. Is no money down an amount? The answer is yes, it is a trigger term. Why? Because no money implies 0, and 0 is an amount. So make sure you know that kind of common gotcha question. Now, in terms of finance charges, The question is, what is a finance charge? And would you have to pay for it if you were not getting a mortgage? So if you want to know if a fee is a finance charge, you have to think, okay, this fee, if I were paying cash for this loan, or if I were paying cash for this home, would I have to pay this fee? And if the answer is yes, you would have to pay it if you were paying cash, then it is not a finance charge. But if it's a fee that you're paying only because you're getting a loan, then it is a finance charge. That might sound kind of funny at first, but let's go through some examples here. So, finance charges. That could be an origination fee, discount points. Why would those fees be things that you're paying only because you're getting a loan? Well, if you're not getting a loan, there's no origination fee because there's no loan being originated. If you're paying discount points reduce the rate of interest on your loan. But if you're paying cash, you don't have a loan. So discount points would be considered a finance charge. Other things would be PMI, right? Private mortgage insurance, or MIP, mortgage insurance premium, any of the other mortgage insurance products, like the VA funding fee, all those USDA guarantee fee. Those are all finance charges. Why? If you're not getting a loan, then there is nothing to insure in terms of the mortgage insurance. The appraisal fee, that would be a finance charge. The credit report fee, that would be a finance charge. A processing or underwriting fee, that would be a finance charge. Why would the credit report fee, appraisal fee, processing or underwriting fees be finance charges? Because you only pay them when you're getting a loan. If you're paying cash, they don't need a copy of your credit report. If you're paying cash, you don't have to get an appraisal. You can, but you don't have to. And processing or underwriting fees, if you are paying cash, you would not have any loan to be underwritten or to be processed. Now, let's talk about some stuff that's not finance charges. Title fees are not going to be finance charges. Recording fees are not going to be finance charges. Transfer taxes are not finance charges. Inspection fees are not finance charges. And realtor commissions are not finance charges. That's because these would still be paid even if you're paying cash. So again, think about it. If I'm not getting a mortgage, would the fee still apply? TILA also sets up the notice of right to rescind. And to rescind just means to cancel. And the right to rescind allows borrowers to cancel certain loan transactions within 3 business days of closing. So the way it works is that everybody on title is going to receive a copy of the notice of the right to rescind. They're going to sign the document once to show that they've received it. And there's another line, the I wish to cancel line. And if they sign there and provide the document, it will cancel the transaction. In terms of the loans that offer the right to rescind, those are going to be owner-occupied refinance transactions. You don't have the right to rescind on an investment property or a secondary home or a vacation home, any non-owner occupied. You do not have the right to rescind. You also don't have the right to rescind on a purchase loan. These right to rescind, when they test on right to rescind, it often takes the form of a question like this. Johnny closes on his owner-occupied purchase on Monday. When does the loan fund? And they like to ask it they like to ask it based on when the loan funds. And the thing you need to think about is, okay, is this loan eligible for the right to cancel? If it is, then it's going to fund on the 4th business day. If it's not, it's going to fund on the same day. So this is an owner-occupied purchase. Well, it's a purchase loan, so it does not have the right to rescind. Therefore, it's going to fund on the same day. We have a bunch of questions like this on nmlsapproved.com, but these are really common way to kind of test on your understanding of funding dates. Now, we also have the MLO compensation rule under TILA, and it has kind of 2 parts. The first part is that dual compensation is not allowed. Loan originators have to decide, do they want to be compensated by the borrower or by the lender? Loan originators cannot be compensated by both the borrower and the lender. That's considered dual compensation, and it's prohibited under TILA. Now, MLO compensation may also not be based on the terms of the transaction. That is the second part. The first part is no dual compensation. The second part is that MLO compensation may not be based on the terms of the transaction. So we are not allowed to pay more for certain loan products, higher or lower fees, higher or lower rate, anything like that. It cannot be based on the terms of the transaction. We couldn't say if it's a 15-year, we pay more than if it's a 30-year. You can't do that. And we cannot even use some sort of proxy for this, right? So if we knew that something was related to this, it's not allowed. We are allowed to pay based on the loan quality, loan performance, total dollar volume of loans originated, or a fixed amount per loan, $100 per loan, for instance, or a percentage of loan applications that turn into closed loans. Now, these are the examples that are written into the law that are expressly allowed, and these are also what is expressly disallowed on the MLO comp rule. So make sure you know that we cannot pay more for certain loan products or fees or rate, but we are able to pay based on loan quality, performance, dollar volume, fixed amount per loan, or the percentage of loans that turn into closed loans. Next up, we have HOPA, which is the Homeowners Equity Protection Act. It was an amendment to TILA. It deals with high cost and higher priced mortgage loans, and it defines two kind of criteria for loans. First you have high cost loans, and then you have higher priced mortgage loans. High cost loans are known as Section 32 loans, and high priced loans are known as Section 35 loans. We're going to talk about what makes a loan high cost or high priced. Talk about the difference between high cost and high priced loans, since they sound almost the same. And then there's some certain requirements surrounding these types of loans. So it's important to understand this. Now, we'll start with high cost loans. A loan is high cost if the APR of the loan exceeds the APOR. APOR is the average prime offered rate. And it has to exceed, the APR must exceed the APOR by a certain threshold. So if it's first lien, it's going to be 6.5%. If it's first lien jumbo, 8.5%. And if it's a subordinate lien transaction, it's 8.5%. There's different thresholds for lower loan amounts. Now, I'm not putting these in the PowerPoint because this is updated annually. So there's a very good chance that when you're seeing this, it has been changed from what it is at the time of recording. So check with your official course to get the thresholds for lower loan amounts for HOPA loans because it changes every year. Now, in terms of the requirements under high cost loans, borrowers who are going to receive a high cost loan will receive a high cost mortgage disclosure, and it says this, and this is written directly into the law. It says that you are not required to complete this agreement merely because you received these disclosures or have signed a loan application. If you obtain this loan, the lender will have a mortgage on your home. You could lose your home and any money you have put into it if you do not meet your obligations under the loan. Borrowers must receive that disclosure prior to closing. Borrowers also must attend HUD-approved counseling if they're getting a high-cost loan. They must also determine the ability to repay. Also understand that high-cost loans do not have the safe harbor protections or the presumption of compliance. And we can talk more about that in depth later. And high-cost loans cannot be refinanced into another high-cost loan within 1 year. This is designed to prevent loan churning or loan flipping. Loan churning or loan flipping is when there are frequent refinances with little to no benefit to the borrower. So high-cost loans are already seen under, already receive more scrutiny, and they're seen under a certain higher risk kind of category. Similarly, they don't want you refinancing high-cost loans into other high-cost loans because this is to stop loan churning or loan flipping. Now, HOPA also sets up high-priced mortgage loans. A loan is going to be considered high-priced if the APR exceeds the APOR by 1.5, 2.5, or 3.5. And these are the same things for the high-cost loans. So if it still is 1.5 for first lien, then first lien jumbo, then subordinate lien. So here's the trick that I use to remember it. HPMLs are as easy as 1, 2, 3 plus a half. And what you need to know about HPMLs is that they have to have an escrow account established with them. So the bar for high cost is significantly higher than it is for high price. But if a loan is high price, it does need to have an escrow account. That means that the servicer will take care of paying the property taxes and homeowners insurance on an HPML. Okay. Here's some common trip-ups. TILA is a large law. The exam covers many, many laws. Do not spend time going down rabbit holes. You could go read all of TILA, and I actually suggest that you do, but I don't suggest that you spend too much time on high-cost loans. I suggest that you do not spend too much time on balloon payment qualified mortgages. There are rabbit holes that you could go down, and frankly, you're unlikely to see a lot of questions about those items. You may see 1 or 2 questions, but I would spend my time making sure I really understand mortgage loan origination activities and mortgage loan products, just the general mortgage knowledge. Going down the rabbit hole on balloon payment qualified mortgages or going down the rabbit hole on high cost loans or HPMLs, frankly, it's just not going to be worth your time. So what you absolutely must know, what are the most important things for you to know for this exam? I'm going to tell you, make sure you know what a finance charge is. Be able to tell me the difference between a finance charge and the APR, right? A finance charge is the cost of credit expressed as a dollar. The APR is the cost of credit expressed as a percentage. Make sure you can explain the difference between those two, and be able to identify if a charge is a finance charge. Be able to identify triggering terms and tell me what triggering terms trigger the disclosure of. Do they trigger the disclosure of the APR, the interest rate? What are they, right? If you use a triggering term, it triggers the disclosure of the APR. Make sure you know that. Be able to answer scenario-based questions about when a loan would fund based on right to rescind rules. Know the APOR thresholds and prohibited actions on high cost loans. Know those same thresholds for higher priced loans. So make sure you know that high cost loans can't be refinanced within 1 year. Make sure you know that high cost loans must have HUD approved counseling. Make sure you know about that high cost loan disclosure. Make sure you know that high priced mortgage loans have a lower bar. There's as easy as 1, 2, 3, 1.5, 2.5, 3.5. Make sure you know that high priced mortgage loans must have an escrow account established. Anyway, that's it for today for TILA. I hope this was helpful. If you have any questions, feel free to leave them in the comment section, and we'll keep making more of these videos. Thanks.